Hello and welcome to episode 65 Portfolio Matters Weekly podcast. Keith is away with a poor internet connection, so he is on sound only. And as ever, there is a lot to discuss this week. But before we move into the details, Keith will read the disclaimer.
Thank you, Richard. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Keith. So a couple of headlines for this week. Ukrainians liberated Bucha and discovered evidence of Russian mass murder of civilians and war crimes. We all know about that, and it's horrendous. Lyle Brainard's speech indicates the Fed will start QT in May, and that has caused some volatility in the markets. And the IEA is planning on releasing 60 million barrels of oil from its strategic petroleum reserve in response to recent high prices of oil. So in the past, we've spoken about the disruption, civil disruption that inflation and increasing food prices can cause. And this is an example where Peru has had to deploy the army to control violent protesters disrupting exports as a consequence of inflation and food prices. And we also have an example in Indonesia, Sri Lanka, I beg your pardon, where there have been protests about food prices and shortage of oil, and the Sri Lankan government has almost run out of foreign currency reserves. And so are we starting to see emerging market instability? So this week's economic data, Keith.
Thank you, Richard. Right, there's quite a lot of important economic data this week, so we're going to go through most of it. So first of all, we had flash EU inflation numbers for March. They came in hot. So the headline inflation number was expected to be 6.9%. It came in at 7.5%, well up on February. So inflation numbers still running high. However, the core inflation number missed expectations. It was expected at 3.2. It came in at 3, although that was up on February. We also had composite PMIs for Europe, and they were continuing to be resilient. So the February number was 55.5. The expectation was that would fall to 54.5 in March, but it didn't. It fell to 54.9. So actually, composite PMIs remaining resilient in the face of all the disruption from the Russian invasion of Ukraine. Now, the big numbers this week were the US payrolls, non-farm payrolls, jobs report, and that was generally resilient, although the headline jobs created number missed expectations. So the expectation was for 460,000 jobs created. Actually, only 431,000 were created, which was well down on February. But hourly earnings exceeded expectations and were at 5.6% year on year, which was well up on February. Now, moving on to the ISM manufacturing survey, new orders showed a big miss. So it was expected at 61.5, it came in at 53.8. So US manufacturers are experiencing a slowing in new orders. And their prices paid, so input prices into the US manufacturing sector, massively exceeded expectations. So in February, the index was at 75.6. In March, it rose to 87.1, massively beating expectations. But employment rose. So you would think from the slowing orders and increasing prices that US manufacturers would be suffering from reduced earnings and might cut back on employment. But actually, The employment index rose to 56.3 last month. The composite PMI rose from February to March, although it slightly missed expectations. And so that was at 57.7 in March. The UK beat expectations and was up on February at 60.9. But in China, we had a big miss. So the consensus expectation for the Caixin composite PMI was 49. It came in at 43.9, indicating that indicating the Chinese economy appears to be slowing rapidly.
That is a very big miss, isn't it, Keith?
Yeah.
Moving on to the charts, we have the EU inflation, which is rising at a very steep rate, and as we know, the EU input price inflation is around about 30% across the board. So I think this inflation rate has a long way to go yet. EU core inflation, whatever significance that has, is spiking upwards. EU composite PMIs, UK composite PMI, US ISM manufacturing PMI, US ISM manufacturing new orders not looking very healthy. US ISM manufacturing prices paid, and US ISM manufacturing employment, and China Caixin composite PMI looking very unwell. So moving on to inflation, Keith, what's the update here?
So the only new data we've had this week are EU inflation numbers for March, which we've just discussed. So the headline number was 7.5%. A reminder that the ECB currently has interest rates at 0%. And although it has stopped the pandemic emergency purchase program, it has partly replaced it by increasing its asset purchase program, which currently running at 40 billion euros a month. So although EU inflation is massively ahead of its mandate of 2%, the ECB is doing nothing to try and get inflation back towards its target rate.
Interesting. And the EU inflation is high and rising, as we've discussed, and really Spain, Germany, Italy, and France, all following the same inexorable upward path, no particular sign of it changing, and as Keith says, the very negative real interest rates. And the graph here showing the Bundesbank main rate, German inflation rate. It's difficult to know what to say really, because it signifies something that is deeply wrong in the Eurozone economy. The market is expecting German stagflation, German GDP inflation consensus. So we have the GDP forecast declining and the inflation rate, as we know, going up. And of course, with the energy position in Germany at the moment being very unstable and unclear, that level of German GDP may not be achieved. So the forecasts for the world economy are not looking good. The GDP forecast in red, declining, and the world economy weighted inflation rate year on year going upwards. So global stagflation is possibly what we're looking at here. US real disposable personal incomes falling. They've dropped below their medium-term trend, and that line is looking like it's going to go further down still. So although wage rises, as we saw, are in the mid 5% in the US, inflation is actually cutting real incomes. So inflation is higher, effectively higher than wage rises. And as we discussed earlier, input price pressures are strong, and there's, I believe, no sign of them weakening. I don't think we are moving into a wage price spiral. I read, I think as we find that individuals come under greater price pressure as a consequence of their inflationary experience for their households, I think we might well find a resurgence of trade union activity and trade union membership too, as people join these unions in order to maximize their bargaining power. And I do think we are moving into a wage price spiral. What do you think, Keith?
Well, currently wages are lagging inflation, and I don't think we're seeing the sort of strength of union power that we saw in the 70s. So nowhere do we see kind of mass industrial activity. Or reminder, in the 70s, the trade unions attempted to squeeze 50% pay rises out of the government and threatening to essentially close down the economy, stop the energy sector like electricity generation. But unions don't have that power anymore. And so I think what we're seeing is that we're having wage growth, but it is behind inflation. And that means that you're not having a wage price spiral as yet.
Interesting.
Let's just talk briefly about the ECB.
Yes.
And what its actions reveal is that it sees its primary aim currently as holding the Eurozone together rather than enforcing its inflation mandate. So it is keeping interest rates really low, because if it raises them, that would be very, very bad for the periphery. In particular, they wouldn't be able to continue with the asset purchase plan if they raised interest rates. And so they're continuing with the asset purchase plan to suppress Italian and Greek bond yields rather than raising interest rates and potentially precipitating a Eurozone crisis.
Yeah, that's very true, Keith. And also, if the Eurozone bond yields rise and the bond prices drop, the ECB becomes insolvent. I'm not sure if technically it's insolvent yet, but it doesn't take very much of an increase in bond yields or fall in bond prices for the ECB to become insolvent. And that then creates serious reputational damage for the ECB. And it would want to avoid that at all costs. I mean, effectively, the Eurozone is so hyper indebted that the ECB's hands are tied. And of course, the invasion of Ukraine by Russia has put very considerable pressure on European countries.
Yes, good point, Richard.
So, Keith, moving on to Invasion Watch.
Okay, thank you, Richard. So this was the situation last week where Ukraine was pushing back Russian forces in the north and Russia was making renewed efforts in the week. But there's been a dramatic change. So this week, you'll see that essentially Russian forces have entirely moved out of the north, which has been reclaimed by Ukraine, and they're now making renewed efforts in the east, but have so far made relatively little progress. But in Mariupol, they are slowly grinding their way to victory. Now, the big news of the week, of course, was the pictures of the massacre in Busha, which matters because, obviously it's a humanitarian disaster, but also it hardens positions on all sides.
Yeah.
If there were to be a ceasefire today, it would be very difficult to envisage sanctions on Russia coming off. I think we're now moving to the European, so Western states entirely repudiating Russia and not wishing to have any economic or political links with it.
I think that's so. The other comment I make about Mariupol is that obviously the Russians wanted it because it's a Black Sea port, but when they get it, it will be a ruin and they will not have the resources to rebuild it. So what they really get is a hole in the ground if they get it. They're desperately now seeking some form of face-saving success, and they simply aren't going to get it. I think, ironically, there is some question as to whether these actions of Putin are going to result in the dissolution of the Russian Federation, even. So our conclusion here is that Ukraine stopped Russia from effecting its primary aim of regime change. It's trying to carve out its territory in the east. I'm not sure that it will succeed in even achieving that. And the evidence of the Russian war crimes has put them beyond the pale, and nobody wishes to treat with Russia in any way at all. And that puts Germany particularly under even more pressure.
The only thing I'd add is that the European Parliament is currently discussing cutting all trade links with Russia in the form of stopping energy imports. Let's see whether they do it. That would be a big step.
And I've read that if Germany stopped importing Russian gas, that it would lead to something like a 10 to 15 decline in German GDP, assuming that they made industry take the brunt of the hit, which would cause massive repercussions for the whole of Europe. And I also read that Russia, there simply isn't available gas production in the rest of the world to substitute for Russian gas at the moment. Even if they could build the terminals tomorrow for receiving LNG elsewhere, the production is not available.
That's true, Richard. We have a chart of that coming up.
Excellent. So the US jobs report. So it was another good month for US jobs, with unemployment now down to 3.6%. The position in the US is slightly confusing. They have a high rate of inflation. They have declining PMIs, declining manufacturing orders, and a very buoyant jobs market. It's hard to synthesize those into a simple view, isn't it, Keith?
Absolutely. But the employment tends to be a lagging indicator. So unemployment tends to fall right up until you have a recession. And what the data we saw this week is slightly confusing, in that manufacturers and the companies appear to be under pressure, but they are still hiring. Yes. So we'll just have to watch these data week on week.
Yeah. And as this chart shows, it continues to look very strong. The recovery has been very rapid. The decline was nothing like the size of the decline in the time of the GFC. But if you take the 2001 recession, where the decline was of similar magnitude, the recovery is much, much faster.
The other thing I'd say about that chart, Richard, is that the line never really seems to go above zero for very long before you get a renewed recession, because essentially you've used up all the employment capacity in the economy. So another way of looking at this chart could be that we are close to full capacity for the US economy, and from there's nowhere but down.
In other words, there is a limiting rate of labour force participation.
Yes.
Yeah. Well, currently we're saying the participation rate is rising strongly, but it's only really rising to that limiting level.
Mm-hmm.
And part-time workers can find full-time jobs if they wish to. There's a lot of employment opportunity available still. Long-term unemployed, so the red line is the number of unemployed people for 27 weeks or more, i.e. half a year. And that has dropped dramatically from the levels that were visible at the time of the GFC, and it's around about the sort of more recent years normal level. That's very volatile, isn't it, Keith, this graph?
Well, it shows how quickly the jobs market has healed this time around, really at astonishing pace.
Yeah. So our conclusions on this are that it's another US jobs report which is strong. The US economy is doing well, coping with all the challenges, although there are fears that it might be heading into a recession. But there are rising energy prices, rising food and commodity prices, rising house prices and rents, rising interest rates, declining living standards, and as we saw, declining real earnings, which is obviously related to the last point. So although the jobs market is rosy, there are other elements of the US economy which aren't healthy at all. And that brings us on to central bank profitability. Keith.
Well, Richard talked earlier about the ECB and the size of its balance sheet. Well, central banks around the world all massively increased their holdings of government bonds during the COVID pandemic. And when the government pays interest on those bonds, then the central banks earn a lot of interest. So in 2021, the US Fed earned 107 billion, whereas the Bank of England earned 13.7 billion in the year to February 2021. And in addition, as the central banks lowered interest rates, they increased the price of those bonds, earning mark-to-market profits on their bond holdings. But now, both those effects are going to start to reverse. So central banks are raising interest rates, which is going to lower the value of their bond holdings, causing them to have mark-to-market losses. Also, as they reduce their bond holdings, they're going to be earning less in interest. And so they'll be passing less back to the government in terms of profits. Next chart.
Well, interesting, just to comment there, Keith, of course, they've bought these bonds at pretty low interest rates anyway. So they may be, I'm hazarding a guess here, they may have bought them at an average interest rate of 2%. So interest rates don't need to rise very high before they start to incur large capital losses on their bond holdings.
Yes.
It's not like interest rates have to rise to 6 or 7%. Interest rates go up to 3% probably, and I would imagine all central banks will be underwater, insolvent.
Yep. And a reminder, the Fed has massive total assets, like bond purchases, which is now unwinding.
Yeah.
But in the second half, starting in May, as Lael Brainard has discussed this week, the Fed will start unwinding its balance sheet, and that will also have the effect of raising interest rates. Next chart. And so this is showing that the Fed has already started to sell some of its bills. So, in conclusion, the reduction in the profitability of central banks should not cause any solvency problems, but could well cause political ones, in that central banks can always recapitalize themselves quite easily, but being seen to lose money or go insolvent could well cause political problems.
Yeah.
And lower central bank income will also exacerbate fiscal deficits.
So moving on to the US housing market again, because we've covered this previously, we see that US house prices continue to rise at a very rapid rate. And house builders who obviously buy land and bank it are benefiting from very significant margin increases. And you can see the long-term margin was been around about 20 to 22%. It's now up to nearly 26%. and that makes the house builders very profitable at present. But we have mortgage rates rising rapidly, as we know, although, of course, the US market is different to ours in that most mortgages are fixed for the term of the mortgage, as opposed to in the UK, where if you fix a mortgage, first, often they're not, but if they are, they tend to be fixed for 3 or 5 years. So the exposure to interest rates of mortgage holders in the US is much less than it is in the UK. Nevertheless, for new buyers, new mortgages, interest rates are rising rapidly. And have hit 5%, which clearly impacts the affordability of new houses or a house if you're a new buyer or are raising a new mortgage. So the market doesn't believe that the house builder profitability is sustainable, which I think is a sensible viewpoint. And so the house builders index has dropped by, what's that, Keith, about 30%?
Well, some 700 odd to 500. So
so it's a big decline.
About 15%, I'd say, Richard.
Yeah. Anyway, in any event, a big decline. So possibly American house builders are not the sector to be in at the moment. Keith, do you want to cover this one?
So this is an interesting chart which shows the performance of various assets in a rising inflation environment. So we're currently in an environment where inflation is above 3% and rising. So we're looking at the dark blue lines, and it shows that in that environment, oil and commodities tend to do best. So oil best, then general commodities, gold miners, and then the real estate sector does worst. So raising high interest rates are very bad for the real estate sector. And thank you to our Discord member Spider786 for sending us that chart.
It's interesting, Keith, isn't it, that gold miners do well with high and rising interest rates, because that isn't the narrative that we have heard over the last few years regarding gold.
Yes.
So that is interesting. And we are in an environment now of high, well, I say high, relatively high, relative to the recent history, and definitely rising interest rates.
Well, I think what matters, Richard, is that real interest rates are very strongly negative.
Yes. Yeah, that's true. So we think that rising US house prices are unsustainable, as are the margins of US house builders. You have to wonder if the same thing is true elsewhere, of course.
Absolutely.
Moving on to yield curve inversion, which always seems to me a little bit like black magic, in the sense that it's this sort of rather obscure mechanism for forecasting recessions that seems to work very well. Keith, would you like to take us through this?
Thank you, Richard. Okay, so this chart just shows that the market is expecting a very sharp tightening cycle. The dashed red line is market expectations for the current tightening cycle, and essentially it's faster than any of the previous ones in the last 30 years. Charts from Haver Analytics that basically show that the 2 to 10 year, which has inverted, is now forecasting a 20% chance of recession in the coming year, whereas the 3-month to 10 year yield curve is forecasting only a 5% chance of recession. So as we discussed last week, different parts of the yield curve are forecasting very different recession probabilities. Next chart.
Yes, and that makes it quite difficult to work out where we really are, doesn't it, in that process?
Yes, absolutely. But if we look at the 1 year forward, 2 year over 10 year yield curve, then the amount of inversion is almost unprecedented. So that is sending out a very strong recession signal. But a yield curve inversion does not seem to threaten an immediate bear market. If we look at the last 4 times we had a yield curve inversion and the performance of the S&P 500 over the subsequent 17 months, it gained 28.8% on average. So it seems that a yield curve inversion does not at all forecast an immediate downturn in the S&P 500. In fact, rather the opposite.
It could be a short-term buying signal, Keith.
Well, yeah, it's slightly mystifying.
Yeah.
And if we now look at the performance of the S&P 500 after the last 5 inversions, you'll see that in 1988, the S&P 500 continued up by over 45%, although in both 2000 and 2005, the performance fell off quite sharply. In 2000, the market continued up slightly for a few months before really trending down. So it is, as always, it is difficult to just take an average. The average disguises a big dispersion in performance. And the other thing I'd say is that different commentators appear to have different starting dates for the inversions, the 2-year to 10-year inversion. So this is the last 2 inversions, which you'll notice these charts are slightly different than in the last chart, but in both cases, the market continued up for about a year, and then there was a sell-off. So at some stage, you need to get out. So in summary, the yield curve appears to be predicting a very strong recession in a couple of years' time. But in the meantime, the equity bull market can very much continue.
So there's a lot of uncertainty.
Yes, but stay long.
Yes. Moving on to some other charts. Keith, would you like to run through these?
Thank you, Richard. Okay, so this is, we talked about earlier, the ISM survey, which is showing that we're having continued supply chain disruptions, delivery times and prices paid rising, whereas production and new orders are falling, and that is not good. That indicates that activity is falling, but and profitability should be falling.
And we also know we have additional supply chain disruption with the lockdowns in China.
Yes, absolutely, which is yet to come through. Now, is this a bellwether for the world economy? This is South Korean new export orders. And this in one chart is why I think we will have a recession in Europe. You'll see that the amount that Europe has to pay for its energy will have risen from less than 2% during COVID to 9.1% of GDP. Now, the US is much lower, and therefore the US economy will probably continue to be stronger than the European one. But in Europe, I can't see any way in which the economy can escape recession.
That's a really sanitary chart, isn't it? And you can see those spikes occur around the time of recession.
Absolutely. Only previous times you've had very sharp rises in the energy burden as a percentage of GDP. That's in 1973 and 1979. A recession has happened in short order. In addition to QT, so central bank selling off its holdings of treasuries, the US government is about to issue a lot of treasury bonds because remember, Trump built up the Treasury General account, which has now all been spent. So the US government needs to get back to raising money by selling bills.
And that is additional financial condition tightening.
Yeah. And earlier we talked about the US housing market. Well, it's not just the US where house prices have risen strongly. In fact, since 2000, US house prices have risen by 166%. Australian houses have risen by 362%, and Canadian houses by 345%. You really think that rising interest rates are going to have to cause a big drop in house prices, and that will have big knock-on effects for economies, because we know that housing is a big driver of economic growth. When people move house, they buy new furnishings, buy new durable goods, etc., etc.
It also imparts a wealth effect if people think they have equity in their homes.
Good point.
So this is one of the Chinese property sector, which we have talked about previously. We know it's that it is slowing because of what we see about residential property. And a reminder, that's about 30%, or was about 30% of the Chinese economy. And it is slowing fast, very fast. And I would say that this is consistent with what we're seeing in the Caixin PMI index, that the Chinese economy is slowing down.
Yes. And China, reminder, has been a big driver of global GDP growth over the last decade.
Yeah. Keith.
Well, I thought this was frightening. So, $1 million is a lot, but how much space can it buy you in residential real estate? And this chart compares different cities, and it shows you that in Hong Kong, $1 million will buy you essentially the equivalent square footage of a parking space. Amazing, 229 square feet. I mean, how on earth is that affordable?
Money has lost its value, hasn't it? It's like it has become confetti in some
yeah. And when we talk about money losing its value, the reminder that I bet everyone watching this podcast is in the top 3% of the global income distribution. And that is only about 22.5 grand a year.
So moving on to equity markets, the weekly checklist on equity markets. The FTSE All shares up 1.2% on the week and 0.7% on the year. The stocks Europe, although down 5.6% on the year, it was up 1% last week. I'm not quite sure what the good news was in reality. I think maybe people have got a little bit used to the war in Ukraine. But I don't think they've got used to the consequences of it. It was a volatile week, wasn't it, last week? A lot of ups and downs. The S&P 500 down over the week, and also 5.6% down for the year. The Nasdaq is having a bit of a torrid time, down another 2% this week, 11.2% for the year. The Topics down 2.5%, nearly 5% for the year. Bitcoin, which had a decent run recently, down 2.7 for the week and 6% for the year, but it has been down a great deal more than 6% for the year, so it's bounced over the last few weeks. The pound versus the dollar down 3.7% for the year, and the dollar index up 4.5% for the year. Note that 50% of the dollar index is the euro, and the euro is significantly down against the dollar over the last 3 months.
I'd just add, Richard, that the all share London listings have a big weighting in commodity producers, yes. And hence that's why the UK market is doing relatively well. Okay, so this is a chart of earnings upgrades, and it shows that they are fading towards 50, which is neutral. So the earnings upgrade momentum is fading.
Which is a sign of increasing or reducing optimism, at any rate, amongst fund managers.
Exactly.
And companies.
But earnings revisions were net positive over the quarter. And so these are various different indices. And you'll see that from the start of the year, earnings expectations have risen from all of them. But if you look at the white line, which is the S&P 500 X energy, then the momentum has clearly faded in the last few weeks.
And analysts increasingly pessimistic about future earnings. Quite an interesting graph has shown the way analysts become enthusiastic and then less enthusiastic, and quite a cyclical manner, which I suppose reflects the cycles of the economy. And they have been very enthusiastic, and now they're slightly negatively enthusiastic, if that makes sense.
Well, for 1 year ahead, global earnings, they're saying, will now be lower.
And similarly for future PE ratios.
One thing that I've found slightly mystifying over the last few weeks is that interest rates have been rising really strongly, but the NASDAQ has actually bounced hard. And you'll see here that value has underperformed growth. Now, tech is long duration assets in that most of their earnings are expected to come in the future, and therefore rising interest rates should be very bad for them. So their performance of growth companies over the last month is slightly it's very counterintuitive and mystifying.
Yeah, I do. I mean, the Russell is not a particularly healthy index, I think, is it? I remember reading a while ago that a lot of companies in it are highly indebted and don't make sufficient cash to cover their debts, and there's all high yield debt, high yield credit in there, and so forth. So maybe the rising prospect of a recession is affecting the Russell, although you would expect that the NASDAQ would be similarly affected. So, very complicated interactions going on. So the energy sector was a big winner in Q1. And we've seen that, and we've actually seen that in Keith's portfolio. And this is the point, that it is a tiny weighting in the S&P. And if it were to revert to mean over the last 20 years, by looking at this by eye, you would say the energy sector has yet to double.
Yes, although of course, the rest of the market could fall heavily while energy went nowhere, is the alternative.
Yes, it just needs a double relative, doesn't it, Keith? Good point. And tech earnings have kept climbing even as share prices have fallen. And some tech companies have actually succeeded in moving into earnings and semblance of profitability, and which is interesting. They're obviously going to be the long-term winners. And whilst the NASDAQ has... Keith, do you want to do this one?
So this chart shows the pink line that earnings for the NASDAQ 100 have risen, although their share prices have fallen this year. So despite the recent bounce, the traditional relationship between rising interest rates and falling tech valuations does appear to hold.
And this shows that analysts continue to remain bullish on equities. Projections for returns over the next 9 months are almost all positive. Morgan Stanley is the obvious outlier, with Barclays being the next most pessimistic. Well, I think that if the central banks, US central bank, does what it says it's going to do, raises rates and does QT, I can't see the stock market is going to do well. And also, I think the whole point of it is to deflate the stock market, because they're very scared about the current rates of inflation. And the way to do that is to make people feel bad, not good. And to make people feel bad, a good way of doing that in the US is to see the stock market drop significantly. So moving on to commodities.
Well, this chart just shows that commodities have had their best start to the year ever. So the green line, dashed line, shows you the trend performance of commodities this year. And all the other squiggly lines are last, I think, 20, 30 years. So is this sustainable, we ask ourselves. So on to energy commodities. Well, it was a mixed week. So Brent and WTI both fell. Now, this week I have added Brent because the US is going to release 1 million barrels a day from its strategic petroleum reserve in the US, and that may have the effect of depressing WTI, which is the US oil future, versus Brent, which is the international one. But actually, that didn't happen this week. Brent fell more than WTI. So Brent was down 3.9%. Amazingly, European natural gas futures fell 17%, despite the discussions of banning Russian gas, although they remain up 50% on the year. Coal had a good week, up 8%. Uranium had a very good week, up 7.2%, is up 44% in the last 3 months. Moving on to the numbers that matter for the oil market. So this week I have added a line that we're going to report US oil inventories, including the strategic petroleum reserve and excluding the strategic petroleum reserve. So including the strategic petroleum reserve, they rose by 1.4 million. Excluding the petroleum reserve, they rose by 5.2. So that is actually bad news for the oil market and worrying for me, in that we should be having a period of continued inventory draws, and actually even excluding the withdrawals from the strategic petroleum reserve, we had a build of 1.4 million, and the withdrawals from the strategic petroleum reserve meant that private sector inventories rose by 5.2 million barrels. So this is something really to watch. If these continue, frankly, it's time to get out of the oil, out of oil equities. In the meantime, US crude production ticked up by 100,000 barrels in the week and is now flat compared to the start of the year. So net, no growth in US oil production over the course of the year, and the rig count ticked up by 2. So this is the oil price. So amazingly, most of the spike caused by the Russian invasion of Ukraine seems to have entirely unwound.
We haven't yet got to the point where economies are slowing because of the oil price, not obviously. There's only a certain amount of fungibility of Russian oil because a lot of it goes from the Western Russia, and that has to be shipped in tankers, so it can't be pipelined to China. So there must be a deficit of oil in the market, one would have thought.
Yes, no, absolutely, Richard. But we had an inventory build in the US last week.
Yeah.
What's going on? So the inventory build is very much dependent on the arrival of tankers, et cetera, et cetera. You can have, we're going to show you a chart in a minute, where even amidst a period of deficits, you will have the occasional week where you have a surplus, but it's concerning.
So this is interesting, Keith. I'd like you to go through this, but I have come across, but not in this level of detail, that there is an issue with the supply of diesel fuel.
Yes. So we talked last week actually about the lack of refining capacity in the West, and this is a very good chart from S&P Platts Global, and it shows top right that you have a big rise in the price of jet fuel and diesel compared to oil, and that is the crack spread. It's how much big oil companies make from refining crude into products. And the lack of refining capacity in the West means that big oil companies, refiners, will be making a lot of money. And we have a structural deficit in jet fuel and diesel. We can't basically, no matter how much oil we have, if we lack the refining capacity, we're going to be in deficit for diesel and jet fuel.
Which is going to put up the price of flights.
Yes.
Substantially.
Next.
And it's very
now, yes, absolutely. Now, this is US distillate fuel oil inventories weekly change. And you will see we've had 2 builds in the last couple of weeks. Although, over the course of the last year, we've obviously had a big drawdown in distillate inventories, but there have been periods when there have been quite strong rises in inventories. So this is something to watch. If we start to get consistent builds in inventories, then that's very bad for the oil price, because it indicates that the high fuel prices are causing demand destruction.
Yeah. So, I mean, it's not indicative yet, is it? But it's something to keep your eye on, because we've got those 2 weeks where it's perked up above zero. But the deficits have been quite large since late January.
Now, the US oil production has been kept up by running down the inventories of wells that were previously drilled but uncompleted. They're called DUCs. And you'll see the green line is the stock of DUCs, which is in sharply declining. And as that inventory runs out, the US is going to have to put rigs back to work to drill a lot of new wells. So that will be good for oil service companies like Hunting. Next chart. And because of the rise in the oil price, despite the rise in oil company share prices, their PE ratios are actually very low compared to history. So they're still cheap. And reminder, OPEC continues to miss its own production guidance, largely because of structural decline in Nigeria and Angola. These are Dutch natural gas futures. Absolutely amazing how much they've fallen back from the peak caused by the Russian invasion. You really think that if the EU votes to ban Russian energy imports, that there's nowhere but up for this chart. I just don't see how they will replace Russian gas flows.
The EU is in a very difficult position, isn't it? It either continues to fund Russian war crimes, or it crucifies the German economy, when the German economy is the driver of the EU financial system.
Yeah.
I mean, where does it go from here? It's extraordinarily difficult. And, the phrase, "we are where we are," comes to mind because clearly it's a result of gross incompetence in terms of EU, particularly German energy policy. But
yes,
the point now is, how do they get out of it?
Yeah. Well, having mothballed 6 nuclear reactors in January, Richard.
Yeah, well, the mind boggles, doesn't it?
Yes, exactly.
Total illogicality.
But in the US, natural gas prices rose sharply this week as Biden has essentially promised the EU that it will export a lot of LNG to replace Russian gas.
And I think emphasis on the word partial replacement, Keith, isn't it? Because the US doesn't produce enough gas to be able to fully replace it, and probably won't be able to for many months, because it would have to drill more wells and set up a massive increase in production facilities, and also presumably another several liquefaction plants and so forth.
Yes. All of which take time to build. But also, Richard, I question whether it will be politically feasible. When these gas prices start rising, and they've already trebled since their lows in January 2020, then Biden's going to face a lot of pushback.
Yes. And the US can be self-sufficient in fossil fuels if it wishes to be. And if it wishes to be self-sufficient, it can control the prices of them.
Yeah.
It doesn't have to be on the world market, which is much worse news for us, of course.
And when we talked earlier about total global gas capacity, if we ban Russian production, then it will only exacerbate an already large gap between gas LNG production and demand.
Yeah, requiring a substantial drop in demand in order to balance the equation.
Absolutely. But last week we were concerned about the Russians demanding that the EU pay for its gas in rubles, and they were threatening to cut off European gas flows if Europe didn't comply. Well, Europe called their bluff, and the Russians have continued to supply Europe with gas as normal.
So this shows the sort of the steady advance of coal. I obviously had this big peak with Russian invasion of Ukraine, but you can see that basically it's following an upwardly sloping straight line, and it has had a good 2022. And obviously Russia is a big producer of coal as well, so there's a lot of uncertainty in the coal market now in terms of supply and alternative sources of supply. Same issue as gas, really. And uranium's had a particularly good week. I think the spike this week was partly due to the announcement by the British government that they would be building 6 or 8 new nuclear power stations. And obviously that has given a boost to uranium. But in any event, it's had a good 2022, as we've discussed, on the basis of moving away from fossil fuel production. And Ukraine has just served to, well, in fact, it is Ukraine is responsible for the big spike that we've seen. So moving on to industrial commodities, aluminium up 20% year to date, but down this week. And cobalt up 16% year to date, unchanged on the week. Copper up 1.4 and 6% year to date. Chromium unchanged on the week. Quite a quiet week, actually, for a lot of these. Iron ore marginally down on the week, up 30% on the year. Lithium has stopped going up for the time being, but 80% up on the year. Magnesium, very good run last year, but is falling this year. Neodymium, quite a chunky drop this week. And nickel up 5%. Now, nickel, as we know, has been the subject of the debacle at the London Metal Exchange, and the price has been extremely volatile. And this is another example of its volatility, but price year to date up 61%, and that seems to be sticking. And a year to date price of tin up 14% with a 4% increase last week. Ferrovanadium 82%, nearly doubled on the year, down a little bit last week. And zinc up nearly 20% on the year. So if you cast your eye down the year to date column, the only one that's down is magnesium. All the others are up significantly. So there's cobalt, copper, a volatile but obvious trend, chromium, iron ore, lithium, magnesium, neodymium, nickel, tin, and ferrovanadium, zinc, and moving on to precious metals. Keith.
Well, another disappointing week for precious metals, which all fell as interest rates rose. So gold was down 0.4%, silver down 1.5%. In fact, they were all down.
Yeah. So there's gold, silver, platinum, rhodium, and palladium. Okay, so on to yields and rates.
Okay, so we had rising rates across the curve this week. And what's interesting is we had actually quite substantial rises in the far end of the curve, the 20 and 30 year. So UK 5 years now yielding 1.5%, the 20 year 1.9%. In Greece and the periphery of Europe, we had quite sharp rises over the week. The Greek 10 year now yields 2.8. And what's interesting is we had sharp rises in Italy. So the Italian 10 year rose from 2% last week to 2.3% this week. And that's interesting. We know that Italy is suffering from very high producer price inflation, much higher than in Germany. And German PPIs are also very, very high. But that is an indication that there's still very strong inflation differentials between the periphery and the core. So the Eurozone crisis is still there, bubbling in the background.
I would also say, Keith, that we've got the absolute year-to-date change in the right-hand column. If you look at the relative year-to-date change, for Greece, Italy, and Spain, their interest rates have nearly doubled.
Yes.
In 3 months. So US bonds have lost almost 20% of their value over the past year after adjusting for inflation. That is with interest rate rises and the effect of the real value of them. And that's not a good thing to have in your portfolio.
Absolutely, but regular viewers of Portfolio Matters will have steeled themselves by selling all their bonds last year.
Yeah. But some people are still advocating the 60-40 portfolio in the financial media, I notice.
Yes, bond people trying to sell their bonds.
Oh, that's so cynical, Keith. The longest, deepest bond market, bear market in history.
Yes, as we have forecast here for the last 18 months.
Flows into bond funds have turned positive. Maybe people are buying the dip.
I think at some stage, if you believe there's a recession, you need to start timing your move into bonds, but I think it's premature.
I think so too. I think you need to time your move into bonds when real rates have equilibrated somewhere nearer 0%.
Yeah.
And slightly above 0%. But I'm no bond expert. I sold all my bonds 25 years ago, Keith. Well, worst timing ever.
Yes.
And German real rates continue to fall. How low can they go?
Yeah. I'm amazed that there hasn't been some rebellion from the Germans in the face of massive inflation and no earnings on their savings.
Yeah, I would agree. I would agree. Maybe there will be. UK 10-year gilt yield marching inexorably up. It has actually pretty much tripled since its lows in late 2021. And the US 10-year yield has doubled since its low in 2021. And I do think these large relative changes can have serious impact below the surface of the economy that it's quite difficult to discern for some time to come. Finally, we're moving on to the seasonal chart, and we are in early April. And as you can see, we are now expecting to have a rise up into late May. And the last week, the markets were up a little bit, and that has proven the seasonal chart to be 100% accurate. That's what we like to see. So basically, ignore all the foregoing, and I think you just buy now, don't you, Keith?
Yes. Richard, what do you get up to this week?
Thank you, Keith. Well, I didn't get up to very much. So my portfolio, this is a 2-week change, is up 0.6%. The change for the year is 6.4%. So I was 5.6% ahead of the FTSE all share. So I'm sticking to my guns of doing nothing, really. I am, as people know, mostly in commodities. I remain that way. I say commodities, commodity producers. And I just thought I'd cover Cameco. So we've covered the uranium price rise. And Cameco has had a good 2022. And I haven't drawn the line on, but if you look at the previous peak in October 2021 at around about 2,800, it's broken above that peak, which a chartist would say is a good sign, and it's made a higher high, having made a higher low. So it is running on sequence of higher highs and higher lows. So I think Cameco is definitely one to hold. And Baldy Resources, which people remember, I bought back in around about April of 2021. And from which point it went inexorably downwards and then sort of fluttered around a bit. So at this point, I think I was down about 40%, but I hung on to it. And there is no news announcement, but I'm guessing this surge in April is to do with the nickel price. So Garibaldi isn't producing, but it has a resource that it is trying to bring into production, and a large nickel sulfide resource. And I think that is that which has perked the market up in its shares. This is a weekly chart, and you'll see that it had a big bounce, but it's fallen, it's come off a bit. But I'm just hanging in there, and we'll wait for hopefully. I mean, they will go into the value at some point, won't they? Yes, at some point, won't they, Keith? And then I wish I'd sold them. But my plan here is long-term hold. But the point, I think, is that with commodity plays like this, you sort of you have to stick with them. And if you decide not to stick with them, you can't curse your luck. They are very volatile. If you decide to stick with them, you have to take the rough with the smooth, and there's no certainty that they won't drop back down to where they were pre-Ukraine. The last thing I want to comment on was gold. So we talked about how gold hasn't really gone anywhere, which is surprising given the rate of inflation that we're experiencing. But this is what's happened to gold exchange traded product inflows, and they've been enormous in 2022 relative to the last decade of history. Yet the gold price hasn't moved. And I'm just going to come back to the comment I made 2 weeks ago, which is people who buy exchange traded products aren't buying gold. They are buying derivatives issued by derivative traders, banks. And this amount of gold hasn't been bought by the exchange traded products. So this is not an inflow into gold, it's an inflow into gold derivatives. And then the other point I wanted to make is crude oil prices from January 1950 to March 2022, based in different currencies. So what do you get for a gram of gold? Well, the crude oil price in gold is pretty much unchanged in 70 years. The crude oil price in British pound has gone up massively. What this really points to is that fact we were talking about when we were covering the property prices. The price of what $1 million buys you in these various cities around the world is that the value of money is depreciating very rapidly. And this is a reflection of what's happening to fiat currencies. And it's why, in my view, the fiat currency system is going to break. But I have no idea when. And on that cheery note, what did you get up to this week, Keith?
So thank you, Richard. I had another good week, which I must admit I'm slightly mystified by, in that both last week and this week, the oil price fell sharply, but I did quite well. So I was up 3.1% this week, beating the oil share, and I'm up 18.4% on the year.
Well done, Keith. Very good result.
Now, I had a couple of sells. So Chariot Limited, which have a gas project in Morocco, spiked sharply, and I sold. I'll show you the chart in a minute. And I made a gain of 120% on my SIP, and that actually gave me a portfolio contribution of plus 2%. But I also sold Tallow Oil, which has been hugely disappointing, and I sold for a loss of 11%. Essentially, Tallow is very heavily indebted, and it has had to hedge most of its production, so it's really not benefiting very much from the rise in the oil price. I added slightly to my Jadestone, which the share price has drifted off despite the oil price rising, and I bought a bit more. Go through some charts. So Shell this week admitted that withdrawing from Russia was going to cost it $5 billion. But every $10 rise in the oil price was going to make it an extra $1 billion in earnings.
Wow.
Yeah. Now this is Entech Technologies, which had results this week, and it reported revenues and earnings that beat expectations, so it is now back in profit, but we are awaiting the first sales of Sabre, which should hopefully happen later in the year. Watch this space. So I'm on to Chariot. So this is the share price of Chariot, which spiked enormously following the recent appraisal well results, which were actually a few weeks ago. And the reality is that first gas is still many years away. And if we move on to the next chart, which is the life cycle of a mineral discovery, essentially, we still have years of development ahead of us. So I think the share price has risen very much on speculation and will now fall back again. So I have sold my shares with the expectation of buying back in as investors get bored over the next couple of years and the share price drift back down. And then finally, we have Tallow Oil, whose share price has been very disappointing. And actually, finally, we have PetroTal, which I did a share talk on. It has a heavy oil field, the Britana oil field in Peru. And as you'll know from the introduction, there are political unrest in Peru at the moment, but PetroTal this week came to an agreement with the local Indians who have stopped their blockade of the oil field, allowing PetroTal to resume oil exports, and that has meant the share price has ticked up a bit. But please watch our share talk on PetroTal. It has a few structural problems with its export routes and continued unrest.
Great, thank you very much, Keith, and thank you all for watching. That's the end of our webcast this week, and we hope you enjoyed it and that you will press like and subscribe, and we look forward to seeing you again next week. So it's goodbye from Keith Jordan.
Goodbye. It's goodbye from Richard Wheater.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.